Have you ever stopped to think about how a business in, say, Ohio can safely buy thousands of products from a factory in Vietnam? How does all that money and all those goods move across the world without anyone getting ripped off? Well, today we're pulling back the curtain on the hidden financial tool that pretty much makes global trade possible. It's called the letter of credit.
All right, let me ask you something. Put yourself in this situation. You need to pay a total stranger thousands of miles away a whole bunch of money for products you haven't even seen yet, let alone received. How do you do that without losing a ton of sleep? They want your money up front, but you're thinking, no way, what if I pay and get nothing? It's a total deadlock.
And this deadlock, it actually has a name. It's called the International Trust Gap. The exporter, the seller, is thinking, what if I ship all this stuff and the payment never comes? And at the exact same time, the importer, the buyer, is thinking, what if I send all this money and the shipment never arrives? This is a massive problem, right? It's a chasm of mistrust that could easily stop international trade cold. So how do you build a bridge over that gap?
Well, the solution is as clever as it is powerful. You bring in a referee, a big, trusted, neutral third party to make a rock-solid promise on your behalf. Let's dig into exactly what that promise looks like.
That promise is the letter of credit, or LC for short. And here's the absolute genius of it. The bank steps in and says to the seller, forget about whether you trust the buyer. You can trust us. We're the bank. We guarantee you'll get paid. The bank literally substitutes the buyer's creditworthiness with its own. But, and this is a huge but, notice that word conditional. The bank's promise only holds up if certain, very specific conditions are met. And this is the most important thing you need to understand about this entire process. If you take away just one idea today, make it this one. The banks involved could not care less about the actual goods being shipped. They don't see them, they don't inspect them, they don't touch them. Their entire universe is paper. They deal in documents, not dresses, documents, not drills. Okay, so what does this whole dance actually look like in the real world? Let's follow a letter of credit from the very beginning all the way to the final payout. So you've got four main players in this game. First, there's the applicant. That's the importer or the buyer who needs the LC. They go to their bank, the issuing bank, which is the one that actually creates the LC and makes that promise to pay. Then on the other side of the world, you have the beneficiary. That's the exporter, the seller, who's going to benefit from this whole thing. And their bank is the advising bank. Simple enough, right? And here's the typical sequence of events. First, the buyer and seller agree on a sales contract. Then the buyer gets their bank to issue the LC. Once the seller has that LC in hand, that golden promise from a bank, they finally feel safe enough to ship the goods. Now, this is key. When they ship, they get a pile of documents in return. Then they take those documents to their own bank. And now, for step 5, this is where the real drama happens. The banks get out their magnifying glasses and check every single word on every single document. If and only if everything is 100% perfect, the bank pays the seller. Now, that sounds pretty logical, doesn't it? A nice, smooth, orderly process. But in reality, it is a high-stakes, unforgiving game of paperwork that has some incredibly strict rules. Take a look at this number, 70%. Any guesses what that represents? That is the estimated percentage of documents that get rejected on their first try. Let that sink in. Up to 7 out of 10 times something is wrong, and the seller doesn't get their money right away. So what on earth is going on here? It all boils down to 2 ironclad legal principles that govern this whole world. First is autonomy. This means the letter of credit lives in its own little bubble, completely separate from the actual sales contract. If the paperwork is perfect, the bank has to pay, period, even if the buyer calls screaming that they received a box of rocks. The flip side is also true. If the paperwork has a flaw, the bank cannot pay, even if the goods are absolutely perfect. And second, and this is the one that causes all the headaches, is the doctrine of strict compliance. This means the documents have to match what the LC requires exactly. Not close, not good enough, exactly. And this leads to what people in the industry call discrepancy nightmares. Shipped 1 day past the deadline? Boom, rejected. Took too long to get your papers to the bank? Sorry, rejected. The weight on the invoice is just slightly different from the weight on the packing list? You guessed it, rejected. Even a tiny mismatch in the product description can stop a multi-million-dollar payment in its tracks. And if you think I'm exaggerating, get a load of this. This is a classic example. The letter of credit specifically calls for men's cotton shirts, but the invoice the seller created says men's shirts, cotton. We all know that's the same thing, right? It's logically identical. But in the hyperliteral world of LCs, it is not strictly compliant. The wording is different, and believe it or not, a bank can and often will reject the documents for that reason alone. A single parenthesis can hold up a massive payment.
Okay, so what we've been talking about is the standard bread and butter letter of credit. But the world of global trade gets complicated, so naturally there's a whole advanced toolkit of specialized LCs for different situations. Now, these are all designed to solve very specific problems. For instance, a back-to-back LC is a lifesaver for a middleman who needs to buy from a supplier but doesn't have the cash. They basically use their buyer's LC as collateral to open another one. Or there's the standby LC, which acts like a backup parachute. It only gets used if the buyer fails to pay on their own. Each one is just a different tool for a different kind of trade. So, after all of this, let's bring it back to the big picture. With all this complexity, all these picky rules, why do people still use these things? Well, because it's all about making a strategic choice. It's about trading one kind of risk for another. So here's the fundamental trade-off. For the seller, the pro is massive. You completely remove the risk of the buyer just not paying. The con? You take on this huge new risk, the risk that a single typo on your paperwork will cause massive delays. For the buyer, the pro is you don't pay a dime until you have documentary proof that your goods are on a ship heading your way. But the con, you're paying for perfect documents, not necessarily perfect goods. And in the end, it all comes down to this stuff. These documents are the keys to the kingdom. The bill of lading is the proof of shipment, the commercial invoice, proof of value, the packing list, proof of what's inside the boxes. If you get all of these, and probably a few others, absolutely perfect, the vault opens and the money flows. But one little mistake, and that vault stays sealed shut. Which leaves us with one last question to chew on. It's really the central paradox of this whole system. When you use a letter of credit, what are you really paying for? Are you paying for the physical goods themselves, or are you just paying for a perfect stack of paper? Something to think about.